The S&P hits a new high as stocks deliver their fourth straight week of gains. And Chris Martenson of Peak Prosperity predicts a serious oil supply issue within 2 to 3 years. I'm Albert Liu, and this is the Power Market Report for Friday, July 22nd. And welcome to the program, coming to you today from Dallas, Texas. Quite an exciting day on the market as the S&P hits yet another high, incredibly. So we're going to talk about that. I also want to talk about how critics are responding to Elon Musk's master plan. And finally, Chris Martenson, the producer of Crash Course, is my guest today. I caught up with him at the Freedom Fest conference in Las Vegas last week. But let's get to the numbers here. The S&P set another record here. This is the fourth straight week of gains, and just get the numbers up here. The S&P closed at 2175. That's up almost 0.5%. Today the Dow Jones was up 0.3% to 18,570. NASDAQ closed at around 5,100. That's 0.5% up. If you look on the week, the Dow was just slightly up. S&P as well, 0.07% up. The NASDAQ up quite a bit more, at 0.79% higher. So after all that choppiness, not much movement, but again, the fourth straight week of gains. Now looking at commodities, was a down day for gold, down 0.62% to $13.22.80. Crude oil was down over 1% to $44.24. Silver was also down 0.63%, closing just below $19.70. So if we drill down a little bit more into what was going on here, it seems that the earnings that have been coming in, they were expected to be rather poor, and I think what's happening is they're beating estimates. We had American Airlines was one of the big winners on the S&P 500 after they met second quarter estimates. Honeywell, Stanley Black & Decker, and Whirlpool also topped estimates. Misses included Starbucks, Chipotle, and Skechers. Of the S&P 500 companies reporting, as of yesterday, roughly 65% beat estimates. That's according to Thomson Reuters. So basically earnings are coming in better than people expected, and that is a factor, although chief market economist at First Standard Financial, Peter Cardillo, was quoted as saying, really, it's the no alternative factor that continues to aid equities domestically. So being, however you want to put it, the cleanest shirt in the laundry, however you want to put it, the U.S. is seeing right now still as the best alternative among a group of not so attractive options. Okay, let's talk a little bit about Elon Musk's master plan. I talked about it a little bit yesterday on the Economy podcast. It had just come out. I just kind of glanced over it quickly, but I didn't see what the market reaction was yet. And seems like there's a fair bit of skepticism. So with anything to do with Elon Musk, there's going to be people that will back him no matter what. And then obviously he has his critics. But more and more people are coming to the critical side. And Bloomberg had a piece titled, "For Elon Musk, Tesla Impresario, the latest act falls flat." So a little bit of criticism there, and that was reflected in the stock, which dropped almost 3.5% yesterday and recovered part of it today. Right now I see it trading at 222 in the aftermarket. So it's recovered partly anyway. But I think what's noteworthy is that the people that I think were more enthusiastic about this project are starting to see that there's some real issues. I got a quote from Dave Sullivan. He's an analyst at Auto Pacific Inc. He says, looking at the master plan, there's no real meat to chew on here, he says, which should only fuel skepticism and concern for cash burn. Without details about timelines and financing, it's all just noise. That was Steve Mann, auto analyst at Bloomberg Intelligence. It's all just noise. And I think so. I think it's just a distraction because really, and there's a lot of talk about the autopilot too, which is obviously an issue. But I believe that they can, like a lot of technologies, they can work this out. But the point is, with or without autopilot, they have some serious issues here. The cash burn is obviously an issue. They've been losing key executives, with a key manufacturing executive leaving earlier for Facebook. The fact that they've missed their performance targets on deliveries is also a problem. And then this whole thing about Solar City, they're going to burn another $2.8 billion on this project. So I guess the main problem is he didn't discuss, as I mentioned yesterday, the timelines, the financing. Where's all this money going to come from? And I think at the end of the day, you have to decide whether this thing, Tesla, is it a company or is it a science fair project? Because if it's the latter, it's doing wonderfully well. If it's the former, if it's a real company and they're spending real money, you have to wonder about what they're doing. Okay, so I want to get to the main event here, and that is my interview with Chris Martenson. I caught up with him last week at Freedom Fest. And if you don't know Chris, he is the producer of the Crash Course video seminar. It's a multi-part seminar presentation on the economy. And he's also the co-founder of peakprosperity.com. He's a PhD scientist, also has an MBA from Cornell. And I was very happy to get him sit down for a really nice conversation about the economy, about Brexit, about what's going on in Europe with the Italian banks, and most importantly, what he sees happening in energy over the next couple of years. So hope you enjoy this. This is Chris Martenson. Welcome back. I'm here with Chris Martenson at Freedom Fest 2016. Chris, thanks so much for joining me. I really appreciate it.
Well, thank you. It's my pleasure.
How are you doing today? You enjoying the conference?
It's been fantastic so far.
Dr. Martenson is the producer of the Crash Course, which most of you probably know about. And you're also the author of a new book. So would you like to tell us about that?
Sure. The new book is Prosper. So where the Crash Course lays out the basic problem, the predicaments actually that we see with economy, energy, and environment being three giant unsustainable trends sort of converging here in time. The next question we get asked most often at my website and in interviews and in seminars that we hold is, well, great, well, so what should I do? And so Prosper is really that. And what we've done there is we've taken a view towards thinking about financial capital as the most important form of capital people are going to be identified with and start there. We have 7 other types of capital that we then lead people through. And an example would be living capital. So living capital is my personal body. If I have my health, I have capital. But it could also be the living capital of the world around me. It could be the garden I have, an orchard. Living in a place with rich ecosystems and clean water is, you have much more living capital at your disposal than somebody living in a highly polluted, really depleted place. So financial capital, living capital, material capital, and we even go further into emotional capital and social capital, 2 things that we think are exceedingly important for people to build up and have. And the punchline of the book is, if you build all these different forms of capital, you'll be happier today, healthier today, you're going to have better relationships, and if certain future outcomes happen, if we have a big market crash, if we have the kinds of financial accidents that people know are possible, you'll be in a position to be resilient and to be helpful to those around you rather than needing help.
Okay, so these are different types of assets. Some of them more lend themselves, I guess, more to measurement using monetary yardsticks. I guess the reason that you would separate them out is because you believe that, for one, they're interchangeable for each other in a sense. There's some trade-offs there, and then there's some asset allocations that are more optimal than others, meaning the typical example is the husband who trades off his family life to enrich his bank account. So these are kind of the trade-offs you're going after, I suppose?
It is. What happens a lot is when people finally discover how fragile our larger system might be, some of them do things like say, oh, we got to leave the city and we got to find a place and go live someplace that's more sustainable. And that could be the right decision. But often it's one of the two people in a partnership making the decision, and the other person is saying, whoa, time out. No, we have stuff that's really valuable here. And so one person might be valuing their physical security, and the other person's valuing their social network. And they both have value. And so the purpose of this book is to elevate the discussion so we can talk about what really makes a very well-rounded life, a more resilient life. And it's putting for open discussion all of the elements that really make a very happy, healthy life.
Yeah, and that sounds very familiar, and I'm suddenly very happy that my wife doesn't watch this show regularly, although we can always just cut that part out. But okay, I want to get to more of the solutions, but let's bounce back to the problem, because Crash Course came out, it seems like a long time ago.
2008.
Right, and things have changed a lot. So 3 E's, environment, energy, exponential was it?
Oh, that's our honorary 4th E, so it's economy, energy, environment.
Okay. The energy scene has changed a lot. Now, has your thesis changed, or is this sort of a short-term bump in sort of this overall trend you see of basically depleting energy and that being a problem going forward?
Well, right here on the show, our prediction is that we're going to see a very serious oil supply issue in about 2 to 3 years. And the reason for that is that we saw oil at 100 a barrel, and there were all these projects ongoing. We had tar sands, ultra deep water, shale, all that. And once oil went below 60 a barrel, none of those projects make sense anymore. So they all got deferred. So all the first investment decisions, the FIDs and the major oils, over $1 trillion of investment hasn't happened.
Right.
So what we're seeing now is all the typical stuff in conventional fields that helps keep that production up. It's infill drilling, it's CO2 injection, whatever your tertiary oil recovery methods are. Those have all been delayed, and so we're seeing actual depletion rates, 5-6% now, showing up across these fields. I don't see any of that investment decisions happening now. I don't think that shale can come back online fast enough to make up the gap. So assuming, here's the caveat, assuming there isn't a major economic collapse, depression, recession between here and 2018, we're going to have an oil shock that's going to really surprise and scare people again.
Okay, and I could certainly see that based on your explanation, sort of the lag in resources coming on and coming offline.
It's a classic commodity story, by the way.
Right, anything that requires a lot of capital investment, a lot of time, a lot of permitting, so on and so forth. But won't the cycle just continue, meaning that these things will come online again, there'll be investment, there'll be entrepreneurship, and then energy will be cheap again?
So here's the most important piece of evidence that we've got in the oil space. In 2014 and now 2015, the amount of new oil discovered, so these are proven reserves that were brought online, were 1/6 the amount that was actually consumed in that year, in each of those years. Okay. So these are the worst oil discovery rates we've ever seen, since the 1950s, but in modern terms, these are horrible. And so people aren't exploring, we aren't discovering, and here's the one maxim in the oil business: you got to find it before you produce it. So the discoveries is another part of the story, but we saw failing discoveries happening even when we were at 100 a barrel. We were still not seeing full replacement rates. So it's just like thinking about a bank account or a trust fund. If you have a trust fund and you're constantly eating into the principal because the interest payments and dividend payments aren't enough for your lifestyle, eventually you have a problem. Right? That's what we've been seeing for about 20 years now. The oil business has been constantly pumping more than it's been finding. Okay. Now, technology's coming along and we're discovering new stuff, but our thesis is the cheap oil's gone. I think 60 a barrel is the minimum threshold needed to entice people back into shale. I think it's closer to 80 for some of the deep water. It's over 100 a barrel for the ultra deep water. We're going to need oil well over 100 a barrel to get oil growth like we saw in prior times.
Okay, let's move on, because that is the first E. The economy-wise, where do you sit on the economy?
Well, this is easy. The prescription I had in the crash course in 2008 stands. I prescribed, my whole prescription of the economic problems we were going to face came in 3 words: too much debt.
Okay.
So 2008 is the warning shot across the bow. We had too many derivatives. We had too big to fail banks. We had sovereign debt levels which were too high. I'm not even talking liabilities, just classic debt. All of those things have actually gotten worse at this point in time. The too big to fail are even larger. We have more sovereign debt. Derivatives are just as large as they've ever been. So my view of the worldwide debt situation is that we're well over 200 trillion with a T in debt worldwide right now. It's too much to grow from. I do believe that the Rogoff and Reinhardt work, which looks at the debt of nations over time, which the work is called This Time is Different, they're right. Every time you get past a certain level of indebtedness, growth is hard to come by. Past another level, it's impossible to come by. We're somewhere between hard and impossible right now.
Okay, so how long do you think this will go? A lot of people were sounding the alarms 7, 8 years ago, and certainly we did have a major shakeout. But the fact that the government is still able to borrow for 1.5%, for 10 years, seems kind of counter to what people were predicting. So how long do you think that, for instance, the government can maintain this level of
much
budgetary
further,
deficit?
much further.
Okay.
Absolutely much further. So Japan is kind of my petri dish for everything that we want to see going on, and I think it was no coincidence or accident that Bernanke was just over there in closed-door sessions with both Abe and Kuroda. And we had some finally today in Bloomberg. We saw a little bit of the open door on what might have happened there. And so Bernanke was talking about permanent bonds, meaning
right.
Why wouldn't
Perpetuals.
Japan issue a perpetual bond,
Yeah.
right? And so if you think about that, it's just a sleight of hand, right? The government issues a perpetual bond, air quotes going up here, and the Bank of Japan buys that perpetual bond. It never gets redeemed. Well, why doesn't the Bank of Japan just print the money and hand it directly? It's the bond thing is just a sleight of hand to satisfy legal. But let's watch what's happening. We're going directly to straight printing, which, by the way, we've been at for a little while. When you say interest rates are really low, they are only low because the central banks are buying. 85 billion euros a month is coming out of the bond market in Europe right now. We know that the Bank of Japan owns completely the Japanese government bond market. We know that the Federal Reserve is a major buyer over here. Could they keep doing that? Absolutely, they can keep doing that. So this, yes, it's gone on for a long time, but here's where my work in peak prosperity comes in. I believe they do that, and every time they do that, it's like we're taking another step up an extension ladder. And they keep doing it, but when it finally fails, it's like falling off from 40 feet in the air instead of falling off from maybe 8 feet in the air. One is painful, the other one is possibly deadly.
Yeah, and it looks like this time around, we're going to have a similar crisis to what we had, say, 7, 8 years ago. But the banks have been sort of clever as to rearrange things so that, for instance, if real estate crashes or if Italian banks crash, you look at who's holding the bonds and who's on the hook. There were a lot of cash buyers of real estate, people, basically raiding their IRAs to fund cash purchases, or mom and pop investors buying Italian bonds. It just seems like the ordinary person is really going to get crushed this time, and the banks may survive, at least over here, but that doesn't mean we don't have a problem. So bank survival is really not the test of a prosperous society when if the major population is getting wiped out or their savings is getting wiped out. So let's move on to the environment then. What is your take on the environment? Why is it one of those 3 E's?
Well, it's absolutely critical. I think this era of humanity will be noted by the hubris we have to think that we don't need the natural world. We really do. And this whole idea that we're going to somehow live like we were living on Mars, we'll just manufacture all our food, we don't need all of these other pieces out there is wrong. We still need the food that we grow in soil. Soil is a living organism. We still need the services of insects. We still need the services of plants to create oxygen. So here's some statistics, things that really frighten me, make me very nervous. So my background as a scientist is in the natural sciences, so I think I have a little more appreciation of this than the average person. But here's a story for you. Where my family went in summer is in upstate New York. It was about a 6-hour drive from where we lived. And when I was a boy, we would stop at every gas station, and you had to, this was my job, cleaning the windshield off because it was just coated with bugs,
Okay.
right? I just made that same drive 2 days ago before I came here, and we didn't get one bug on the windshield after 6 hours of driving. In Germany, they've been recording bugs in fields and noted a 40% decline in the past 25 years. So the insects are disappearing. People are familiar with the sentinel species. Oh, the butterflies. Ooh, the honeybees. It's because we sort of care about those, but species nobody thinks about or cares about also disappearing. So we're actually wiping out right now, and I believe it's through some combination of pesticides and habitat loss, and it's a complex series of things, but we're wiping out the bottom of the food chain. To a biologist like myself, that is a horrible idea, because we don't even understand the complexity of the systems out there involved right now. But nature always has a curveball for us, and it says, if you wipe out that food chain over there, I'll replace it with something else. You might not like it, right? So in the Mediterranean, they've had entire anchovy harvests where they over-harvested, they actually wiped the anchovies out, and you know what they have now? Jellyfish. And it's not like they just had too many jellyfish, we'll get rid of them. It's that it's flipped from being an anchovy environment to a jellyfish environment, and nobody knows how to turn it back into the old one because we don't want the jellyfish environment, but that's how nature works. It has like, they're like tipping points, and once you tip into this next bowl, as it were, your marble rolls in that bowl, and it's very hard to get it back into the other bowl you wanted to inhabit. In my own lifetime, I've seen extraordinary changes in the natural environment, all of which can be summarized to the very rapid loss of species. Everything. Turtles, amphibians, reptiles, insects, mammals, you name it. So in that E, I think we've got plenty of signs in the environment saying, whoa, we're seeing ecosystem stress. That's part one of that story. And then, time out, we should be talking about this more seriously. And then part two is just the resources that we consume. Fresh water, soil, ore bodies. Those are all depleting at pretty extraordinary rates, which lead me to confidently say we're not going to be continuing to harvest from the natural world in the next 20 years like we did in the prior 20 years.
Okay, so how do you tie this in? This is at least partly an economic argument.
Absolutely.
You consult on financial questions. Mm-hmm. How do you tie this into just how the financial system is working or how investors are going to feel it? Because you outlined some pretty, I guess, scary scenarios and something that would be of intense interest to a scientist. But what about a portfolio manager? What am I supposed to make of this?
And here's why this is so critical to tie this together, because very few people are. Any portfolio is, let's just take a model portfolio, 60-40 stocks, bonds. Let's say it's an endowment. Let's say we're Yale University or somebody, and we've got a big endowment, and we're trying to manage that for the next 100 years, presumably, or for a very long time horizon.
Yeah.
Implicit in the price that you have for the bonds and stocks in your portfolio is that you're going to get your money back for those things, right? A stock has no value except for its future cash flows, ultimately. We understand that from dividend flows. A bond is only useful for the coupon and its repayment of principal. The value that we see in the stock and bond portfolios today have implicitly baked into them extraordinarily high growth rates to justify the current prices of them. That's fine. Now let's wander over and ask, what does growth really mean? Because growth doesn't mean the price of IBM went up. Growth means that more goods, more services were sold and consumed next year than this year.
What do you mean by extraordinarily high? Except for, off the top of my head, Amazon.
Amazon, good one.
Well, that's like for all of time. You're paying for those earnings. But apart from that, do you see that in the S&P?
So price to sales right now, median price to sales is at an all-time high. It's never been higher in the S&P. So that's like stocks in terms of future sales are priced as expensively as they've ever been priced in all of history.
Okay.
So that means there's a pretty hefty growth premium.
You think that tail goes far and out into the future, that some of the problems that you're talking about with the environment are actually going to cut into that? Are they going to cut into that in the form of taxes? Is that how the rubber meets the road?
No, they're going to cut into it in that growth won't be possible in the ways we're used to it. So 6% nominal, 4% real growth is something that a lot of people bake in on a global basis. What if that's only 4 and 2? What if that's only 2 and 0? What if it's actually, God forbid, negative, right? So each one of those, when you make a new assumption about the growth rate, it completely changes what you're willing to pay and how you're going to value things.
Okay.
So in my view, I think that it's entirely possible that we'll see half the value of all the bonds that are currently outstanding as being proven to be unpayable as in times going forward.
Would you agree that governments pose a much larger threat right now to future growth? I mean, we just discussed, you brought up the fact that once you have a certain amount of debt, it's difficult to service, it subtracts from your growth. Isn't government the single biggest threat that we face now? And shouldn't there be a G? Shouldn't it be EEG or something? There should be a G in there somewhere.
Well, there should, and it's something I do talk about a lot, and it goes like this. Throughout history, it's pretty clear that when governments get themselves into too much debt situations, which is very frequent, it's almost, I can't think of any historical examples where the government said, oh, well, let's just admit we went too far and let's figure out how to pay that back under what's called austerity. Nobody likes austerity. So governments either try to inflate out from under it or go to war in order to come out from under it. I don't like either of those outcomes. So I'm very concerned that when I see the encroachment of government right now, they're all doing what they always do, which is to consolidate power rather than distribute power, to double down on the mistakes that were made rather than admit mistakes were made. So here's the prime mistake. Since 1975 till about 2008, the United States was growing its debt at twice the rate its underlying income or GDP was growing. Any sixth grader can tell you can't do that. Any person listening to this who has a credit card can tell you, I can't make my credit card debt go up 10% while I'm getting 5% raises. Sooner or later I have a math problem. Well, instead of admitting that, we said, no, we're going to make this go on for a little bit longer. That's classic. What I'm worried about is that what will the response be when that finally breaks? Because history is pretty clear that blame is the usual easy way out for politicians.
Yeah. Now, you know, the math doesn't lie, and the math can't be fudged, but in this equation that you draw up, or conjure up, basically it's the constants that aren't constant, right? So tax rates change,
Yep.
purchasing power changes, so
Yep.
what is fundamentally a mathematical truth can be fudged just because they can change the constants. I've got two more questions before I let you go. Chris, just on the Eurozone, are you following that? Have you been, do you have
closely.
opinions on Brexit, the Italian banks? What do you think is going to be the outcome, first of all, of Brexit? Is this going to go through? They talk like it's going to go through, but they always leave the door open. It makes me wonder.
Yeah, I don't know what they'll end up with. It'll be something watered down from what was voted on, I'm sure of that. I was a huge fan of Brexit. I remain a huge fan, not because I'm sure it'll have some pain associated with it. I'm not the fan of the pain that will come with it. But for me, that was the only example in my adult lifetime of a people saying no to the continued reach of globalization. So that was the first roadblock put up in a world of trans-Pacific partnerships and transatlantic associations and all these other sort of globalization and corporate overreaches. To me, Brexit represented people standing up and saying, our lives are getting harder, not better. We want to put a stop to that. We'd like to assume control again for our own destiny. I was a fan on that front.
Yeah, me as well. And finally, the banking crisis in Europe, starting with Italy, but possibly spreading contagion. What do you see? What do you see going on there?
I can't believe anybody has their money in an Italian bank at this point in time. There's 320 billion euros of non-performing loans in the Italian banking system. It exceeds its capital by a factor of 10. In fact, it's 20% of the Italian GDP. So can you imagine if somebody said, oh, in the United States banking system, there's $3.5 trillion of non-performing loans in the banking system? You'd say, oh, that's a problem, right? You know, so Italy's banks are insolvent. Insolvent is what precedes bankruptcy, which is a legal process. I see no possible way for this for Italy, under the current structure of laws that exist in the EU around how bail-ins are supposed to happen and how recapitalizations can happen. There's nothing they can do right now except to go through a very painful bail-in process that will shatter the Italian banking system.
And talking about emergency provisions, special situations that allow them to do that, but I guess we'll see what happens.
Well, of course, rules are made to be broken, right?
Yeah,
So they will have to break those rules, and but not before a painful banking crisis comes.
Excellent. I've been speaking with Dr. Chris Martenson at Freedom Fest 2016. His website is peakprosperity.com. Please visit him, Chris. Thanks for joining me today here, and I really want to get you on the program again, so I hope we can do it again soon.
Thank you. My pleasure.
Hi, I'm Albert Liu, host of the Power and Market Report. If you enjoyed this video, I invite you to subscribe to my channel by clicking the button on the top left of the screen. And don't forget, you can also visit us on Facebook and at powerandmarket.com. Thanks again for watching.